Revenue? Profit? Are you new to investing and getting lost in all the jargon? Well, you won't be after today's episode. Welcome to Get Started Investing, a podcast where we help you make the most of your money. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. We are talking about some of the fundamental metrics that matter to companies.
Yeah.
And as investors, ultimately what we're doing is investing in companies, even if it's through an ETF that holds hundreds or thousands of companies. So it's good to just pause and establish what matters to companies, what drives them forward, what increases their share price, and ultimately what makes you money as a part owner of these companies.
And today's episode was inspired by a question from a new community member.
Hey Equity Mates, love listening to podcasts on my way to work. I'm starting to look up new companies, but I always get confused by revenue and profits. Can you please explain? Thanks.
Well, thank you for the question. A reminder that you can ask your questions at equitymates.com/contact. There is a option there to record a voice note, and we really do love to hear your voices. So Bryce, we are going to unpack some of these fundamental company metrics. How a company makes money, the difference between revenue and profit, why revenue doesn't tell the whole story, and why profit matters to investors. It's like business studies in year 10 all over again.
It, yeah.
I actually didn't do business studies, so I have no idea what you do in that class.
I did business studies.
I imagine these are some of the topics
One
you
of
do.
my favorites. Yeah, I think absolutely.
All right, will you take it away then?
Welcome to business school. So let's start with how a company makes money. And we are going to go back to our good old Espresso mates.
Oh, yeah. Okay. So
the business that we're running, if you've just joined us for the first time, Ren and I, in a hypothetical world, own a cafe, 50-50, called Espresso Mates.
Yeah. Hypothetical for now.
You want to actually own a cafe?
I wouldn't be against a coffee bean, subsidiary.
Coffee bean subsidiary.
Like bloke, like Den and Kemp sells grumpy coffee.
Yeah.
We could sell Espresso Mates.
We could do Espresso Mates.
Or
that's true.
Pod Save America, I'm pretty sure have a coffee as well.
Do they?
Yeah, I don't think it does very well.
I don't know. I've never heard of it. Anyway, go back to the episode around what is a stock market if you want to get the full detail on Espresso Mates.
Yeah.
Anyway,
Or as Bryce calls it, Espresso
no,
Mates.
I don't call it Espresso Mates. But anyway, how does Espresso Mates make money? Every day, Ren and I are in there. We're selling coffees. We're paying our staff. We are working our butts off to try and build a life in the cafe business. And we need to make sure that we are making enough money or enough sales to cover the costs of running the business. We need to sell coffees, croissants, you name it. We are trying to make money.
I think people get what you're selling at a cafe.
Sandwiches, we open for dinner.
Who's eating sandwiches for dinner?
Lunchtime, dinner.
So we need to make sure we have enough money to cover all the costs, but then hopefully we also have enough left over as owners of the business to put something in our pocket at the end of the day, because I have been noticing that you've been skimming from the till.
Not true.
And so the terms we're defining today are literally just terms used to explain that situation.
Yep.
It's finance jargon that is used to explain the very normal process of just trying to make money as a small business owner. So let's start by defining the two terms, revenue and profit.
So revenue is all of the money that Espresso Mates brings in from selling all of the products in the cafe. Coffees, you name it. I'm not going to name all the products that we have.
Yeah.
So that's revenue. Profit is the amount of money left over for Espresso Mates after we cover all of the running costs of the business.
Yes.
And that is then what distributes to the owners or is reinvested back into the business.
Yeah. Now, we said earlier why revenue doesn't tell the whole story. And we've got two examples of ASX listed companies that we think illustrate why revenue can sometimes be a vanity metric.
Yeah, big time.
It can
Misleading.
It can make you look good,
Yeah.
but it might be hiding some things under the surface.
Yeah.
So let's talk about two companies. Aristocrat Leisure. You familiar with it?
You would be.
Oh, here we go.
Gambling machines.
You're a big shareholder.
You love
in
gambling.
True. I play the pokies while you're out the front in the smokers area.
What's worse?
So on one hand, Aristocrat Leisure. Another company, Grain Corp. Familiar?
Yeah, so both of these are real companies, we should say, listed on the ASX.
Yeah.
Well, we're moving out of Espresso Mates.
I actually already said they were listed on the ASX.
Oh, okay, nice. I was thinking about when I'm next going to have a cigarette.
Clip it.
No, don't clip it. Don't clip it. Don't clip it.
That is staying in the edit. So Grain Corp is a big agricultural trader. They obviously buy a lot of grain from Australian farmers and then sell it. So these two companies, the reason we've chosen them is they both made about $6.5 billion of revenue in financial year 2024. So to be specific, Aristocrat made 6.6 billion and Grain Corp made 6.5 billion.
Nice. So pretty even.
Pretty similar sizes. Yeah. Here's where things look different. So Aristocrat, their profit was $1.3 billion. So you do the maths there, 6.6 billion in revenue, 1.3 billion in profit. So their costs were about $5.3 billion. Staff, upkeep of gaming machines, whatever, research and development of new gaming machines, whatever it is. Advertising, you're not allowed to advertise.
No.
All those VIP lounge signs.
Yes.
Yeah. So 6.6 billion in revenue, 5.3 billion in costs, 1.3 billion left over in profit. Flick it over to Grain Corp. So they had a similar revenue number, 6.5 billion in revenue, but their profit was just $61 million.
Wow.
So that means their costs were about $6.44 billion. So paying Aussie farmers for grain, shipping it around the country or overseas, whatever other costs they had, their costs were a lot higher and so their profit was a lot lower. And what that means is that the market values these companies very differently.
Yeah.
Even though they're bringing about the same amount of money in sales, Aristocrat valued at $42 billion. Grain Corp valued at $1.7 billion.
Yeah. We should also add there that you'll often see a lot of companies listed on both the Australian and the US stock markets. Enormous companies have huge revenue numbers, but aren't profitable at all.
Yes.
So don't be swayed by monster. Uber was a classic example. Airbnb, classic example. Huge revenue numbers, but unprofitable for so long.
Yeah.
And it wasn't until they started turning a profit that their share prices really started taking off.
Yeah. So this is why revenue is a vanity metric. Let's really drill down on profit. Why does profit matter to investors? And I think there's a few reasons why just practically profit matters to business owners. And remember, as shareholders, we're all part owners of the companies that we own shares in.
So there's three reasons that profit matters to investors. Firstly and foremost is that profit ensures the company is going to survive. It's not going to go out of business because it's earning more than it is spending. It's simple personal finance, really.
Yeah.
It's like the company is living within their means, and so they're going to keep going year on year on year.
I mean, if you think about the Uber example you gave earlier, it was unprofitable for so long and it had to keep finding money from other sources, had to keep tapping investors for more money, had to keep getting debt. And there were questions about how long it could keep doing that. And, use the personal finance example earlier. If you're spending more than you're bringing in, you've got to be tapping credit cards and stuff like that.
Yeah.
It's unsustainable.
Unsustainable.
The only way to be a sustainable business is to be a profitable business.
Yeah.
The only way for Espresso Mates to keep pumping out those, what do you do? Double shot soy latte?
Yes, only.
Is to be charging more for that coffee than it costs us to make it.
Yes. So if we're profitable and we're in business, we then can use that profit to grow the business. This is what investors love as well. Companies reinvesting the money back into the business. So using Espresso Mates as the example, that would be us using the profit to go and buy a bigger coffee machine so we can service more people who come through in the mornings and pump out more coffee.
Yeah, we can open a second location.
Exactly.
We can hire more staff.
Yeah.
We can get higher quality beans.
Yeah.
But it also makes it easier to go and get other sources of money. So a profitable company can more easily walk into a bank and say, hey, we're good to pay this loan off that we want to get. Or it makes it easier to go to investors and say, hey, we'd love you to invest in our business. And look, we're profitable, so you'll make a return.
Yeah.
So it not only means that they're making money to reinvest in the business, it makes it easier to get other sources of money to reinvest in the business.
And so then the third and final reason why investors love a profitable business is because businesses can then reward their shareholders with that profit through the form of a dividend payment. We actually did an episode not too long ago on dividend reinvestment, so check that out. Dividend payments, or the company can buy back shares from shareholders, and by doing so, that is another form of adding value to existing shareholders.
Yeah. So that is why profit is what really matters, and why, as an investor, when you're looking at companies, that's really where you want to start. And there's nothing wrong with buying a company that doesn't have a lot of profit or isn't unprofitable, but you've just got to be aware of what you're buying. And really, you've got to have a view that at some point there's a way for that company to get profitable.
Yes.
Yeah.
Well, thank you so much for the question. That brings us to the end of today's episode. We do have a 4-step checklist to help you analyze any company. And if you are interested in understanding more about investing in individual stocks and getting into the nitty-gritty of revenue and profit and thinking about how it impacts the companies that you're invested in, make sure you download that free resource. We'll put a link in the show notes or the YouTube description so you can download it. But as I said, that brings us to the end of today's episode. Like the video, leave us a comment below in the YouTube descriptions. We love getting your feedback. It really helps us understand more of what you want from us here at Get Started Investing. But Ren, we'll leave it there and pick it up next week.
Sounds good.